Wonderful. Well, thank you all so much for having us up here today. We're excited to have a discussion that we hope is interesting. I'm going to start with some brief introductions. I'll introduce myself, and then we'll ask all of our panelists to say a quick word about themselves and their background. I'm Graham Pingree. I'm with Sindana Capital. We are a pre-seed and seed venture fund of funds. We exclusively invest in small funds, investing at the very earliest stage into companies. We have been around for more than a decade, and we launched our international program in 2018. And today we've backed 4 fund managers in Europe, and we're really excited about our global seed program. So thrilled to be here. I'll ask our panelists to briefly introduce themselves.
Hi, everybody. My name is Carmen. I'm a VC turned angel at Cocoa Ventures. Basically, what we do is we invest angel checks and come in as like a small partner, like an angel to the founder, but we bring on all our VC network and VC expertise because we've been VCs for like 7 years. And so want to become the in-house VC for founders. It's a 17 million fund, so very much into the micro fund theme that we will be discussing today.
If the question was who is the odd one out on the panel, it would be me, because I'm the one who is not a fund. Signal Rank is a company that partners with seed funds. I loved the fact earlier that early stage funds are where everything's happening. I believe that to be not entirely true, but it's a very fortuitous fact for what I do. We partner with seed funds who have follow-on rights. They typically every company that becomes a unicorn is born in the seed stage. And funds like Cherry VC here in Germany, or Seed Camp, or Local Globe, and many others are the places those future unicorns that grow up. Those seed funds run out of money by the A round. They don't typically do their follow-on rights. We acquire those rights in partnership with them and give them 20% of the profit. And we deploy up to 100% of their follow-on capital at the B round, the C round, and the D round. We aggregate it up. You could think of us as a horizontal opportunity fund sitting across the top of the best seed funds.
Hello, everybody. My name is Oliver Heimes, partner at Lakestar. Lakestar is a pan-European fund with offices in London, Berlin, and Zurich. We believe that European founders, European companies absolutely are need to have a European vision when it comes to tackling regulatory markets, regulatory frameworks across the various markets, and to scale across Europe is not similar to any other geography. And that's why we heavily focus on Europe and provide a pan-European network. For myself, I spent a third of my entire life at Lakestar, which is pretty much 100% of my working time. I joined Lakestar pretty much at its inception when we were 4 people. By now, the firm is 50 people strong, with more than $1 billion of assets raised and deployed here in Europe.
Wonderful. I'm Alex Niehenke. As with some of you, it's about 3 a.m. for me right now. Do a little bit of time traveling. So if I mumble stuff that doesn't make sense, apologies. I'm with a firm, Scale Venture Partners. We've been around for about 20 years. We're investing out of our 7th fund. It's a $600 million vehicle. We invest in early stage business, software, and services companies. About roughly 20 of them in each fund. I've been doing that, like I said, for about 20 years. I joined the firm 10 years ago. I was at another set of venture funds before that. And at this point in time, it's the only thing that I know how to do. And hopefully that does work out. So back over to you, Graham.
Wonderful. Well, thank you so much for being up here today. Excited to have a chat. One of the things I wanted to start talking about is kind of a wave that we've observed in the United States is this emergence of nano funds, right? We've increasingly seen very small funds that are either angels that are institutionalizing or potentially successful partners who want to go back to basics and raise smaller vehicles. I'm curious, is that starting to happen here in Europe? And I presume you have a positive answer. And then would love to hear maybe how some of the life cycle funds think about that trend.
Sure. So basically, I think that Europe's pre-seed and to some extent seed is really non-institutionalized yet. And we have this feeling here that it is yet to be taken. And there is certainly this kind of emergence of a lot of nano funds, micro funds varying from as small as like 4 or 5 million to like sub $30 million dollars. And I guess the thesis there, and putting sort of my money where my mouth is that the time for Europe is now. There's never been more like talent, there's never been more quality of capital. If we believe that, we can safely assume that in the next 5 to 7 years, Europe will be producing many more large outcomes than it is producing today. If you agree with that, then a lot of these future large outcomes are actually being born today, because you were saying the future unicorns are at seed at one point. And so the thesis of a lot of these microfunds is, well, we see them, right? Like we see these companies. The war is not to see, the war is to win at seed right now in Europe. Why is it to win? Because a lot of funds have grown much larger, they need more stake, so they are competing for stake. So our thesis is, let's just not fight that war to win. Let's just optimize for access rather than stake and make sure that we can be in as many of these future large outcomes as possible. And I think that is kind of like a shared thesis that Europe's current sort of expansive market allows for, and which we're all sort of betting on.
Wonderful.
And I would add to that, I think it's extremely important in Europe to have those early funds and for them to be professionally managed by people who know what it takes to build a company from early on. So if we look at the unicorn landscape across Europe, they are not coming from San Francisco, Boston, and New York as 3, 4, or 5 cities. It's across 100 cities across Europe, right? And so those 100 cities cannot be covered all by a single fund or by a few large investors. They need to be nurtured from the ground up. And so we see the emergence of nano funds, seed funds, etc., is something extremely important. And at least for us, we make it a habit to be in active contact with all of them. And so we've seen definitely a big rise in that over the last couple of years, building for and hoping for that kind of rise is followed by later stage capital then following, right? I think we don't see a lack of early stage capital in Europe so much as maybe more the later stage side.
And I'm curious if some of the bigger kind of European platforms, have they invested in some of these funds? I mean, that's a trend that we see in the States, right? Andreessen, Sequoia,
So,
Tiger.
Yes and no. I think having very close relationships, 100%. Co-investing a lot, 100%. There might be occasional situations where there's investments, but I wouldn't call it a norm yet.
Not LPing into funds.
I agree, but in our case, for example, we decided to not have VCs as LPs, not VC funds as LPs, because our whole position is about being neutral and independent to founders, and we thought that there could be some sort of conflict. But actually, we got all the multi-stage, not all, but like most multi-stage funds with whom we had a relationship, wanting to invest one way or the other. So I think it is still early trend, but it is becoming more of a norm for access to deal flow, mainly. I
was going to say, if you unravel what's really happening here, it has quite a long history. There's a guy called Jeff Clavier, some of you will know, Uncork Capital. He will kill me for saying this, but back in 2005 when we started TechCrunch, Jeff was pre-fund. He was doing personal investing. And he helped me raise a round for a company called Edgio. And for the next 12 months, I paid him a stipend. And during that 12 months, he raised capital from Norwest Ventures. And that was 2006, 2007. Then Sequoia and others started doing scout networks, where very small amounts of money are given to lots of people to go and do scouting, which now is starting to appear on seed fund cap tables. You know, such and such a person, bracket Sequoia Scout, is showing up. And that person probably has a couple $100,000 to play with. So I think what's happening, and now then you see the Tiger Global founders personally starting to invest as LPs into seed funds. So I think what you're seeing is there's been 3 asset classes have emerged that are quite different. The A-round and before asset class, the kind of B through D or E asset class, and then the growth asset class that Scale is part of. And they have totally different investors, totally different return characteristics and time characteristics, totally different risk profiles. And everyone knows that it's a value chain. So it all starts at the earliest stage. So the more little things you can put out there that are finding the good companies, the better. And I think that trend is accelerating. You know, question is great, because I think that I don't think it's happened in Europe. I'm European, but I've lived in Palo Alto for 30 years now, so I don't really know. But it doesn't feel as if it's happening as much in Europe as it is in America at that scale.
So I think the question goes back to the war is like to win is absolutely fierce, like at each stage. So the more chips, as you said, that you have to maximize your options to win, the better. I think it is happening at VC funds wanting to invest. It is happening definitely at GP level, investing into funds. It is even at micro funds. We are LPs within each other. So it is incestuous, so to say. Probably the scale is still much smaller than it is in the US.
I do know Saul Klein at Local Club and his father are LPs in lots of smaller funds.
Yeah, based on.
Yeah. And Alex, how does Scale think about some of these kind of nano funds, maybe particularly as you look to, if you're investing in Europe, do you prefer to partner with smaller local pre-seed or seed funds who have feet on the ground? Or are you kind of agnostic about that? How do you approach it?
At the stage that we invest, there's always somebody on the cap table, usually of some institutional source, a nano fund, a seed fund, a micro fund, high net worth angels. So those partnerships are incredibly crucial for us. And if I think about what we saw happen in the US over the last 15 years, I think that there was just a natural evolution as some of the traditional early stage managers, for whatever reason, went through their processes, got old, got lazy. And it created this whole new crop of, folks that first called themselves micro managers, nano managers, then became seed managers. And now they're just early stage managers. And that maturation, I think was kind of easy to foresee. In my perspective, the European ecosystem didn't have as robust of an early stage ecosystem as the US had. And so I'm ecstatic about what's going on in the European ecosystem with these nano, micro, seed stage managers. They look, smell, everything to me identical to their US counterparts. They're folks that we work really, really well with. And, we are based in San Francisco, California, and we have, 7 partners sitting in that office. And while a bunch of us carry, myself included, European passports, there's no doubt that, a 12-hour plane flight is a 12-hour plane flight. And so European coverage has to have some sort of partnership. And that partnership is going to be with folks who are based here and really have those local relationships. And while we will go through the hard work of identifying the trends and therefore the interesting markets and maybe even the companies that we like, the individual knowledge to those companies, the connections, being able to build up a relationship with somebody like Carmen is going to be incredibly important for us as we continue to invest in Europe as we have.
Maybe last thing to add there, I think what's at the center of what we do, it's the founders. Right? So sometimes that's easy to forget when we talk about money and venture the entire time, but the founders are in the end the absolute epicenter of what we do. And the quality of the founders when it comes to them, right, having founded companies before, being serial entrepreneurs, being really educated in those various markets in Europe has definitely increased over the years. And so we've seen them to be extremely more, challenging, but demanding towards the early stage investors, right? And so the rise of early stage local investors, they require quality on the ground. And so sometimes it's not enough to have somebody 12 hours away, even if they bring an amazing brand name. They want to have high quality on the ground and then build the cap table from there. And so I think that's one of the biggest pulls that we've seen in that market.
And you think that's still as true today, post-pandemic? I mean, one thing we've observed is like the fluidity of capital has changed in the US. Does it feel that way in Europe, or you still think it's as important as it ever was?
Maybe even more important, because while fluidity of capital, and in some ways talent, it clearly has shown, right, to be there and fluid during COVID. Again, you can't do Europe without knowing regulation, right? If you build a healthcare technology, a fintech, a crypto, even gaming company, whatever it might be, there is some point when you're going to be successful, or you're going to be at a 10 million, 15 million revenue line in 1 to 2 years, you're going to hit a regulatory hurdle at one point. And whether it's just a simple registration somewhere, or whether it's something bigger, passporting, whatever you do to other countries. And so that's something that didn't go away over COVID, sometimes even got stronger, because some of those more digital laws were written because of COVID. Right? Think about healthcare technology. France, Germany, UK, they all amended their laws, but they're still state by state. And so you need somebody who can navigate that. And so I think in some ways it got even more European-centric.
I was going to say, it just occurred to me, Europe is ahead in one way, which is crowdfunding. Especially in like Seedrs and Crowdcube and others. So if you think of nano funds, because of tax breaks, the amount of money that's coming through those platforms into, let's be honest, not the best startups. It's a large amount of money and it's kind of being misused. So there must be an opportunity, given that money is flowing, to make it flow in a better direction, which seems to be missing. In the US, on the other hand, the Jobs Act, which allows non-accredited investors to invest in private companies, was very limited. The regulators hate it, even though it's limited, and fight against it. And so the US, you kind of have to be rich to invest in startups. In the UK, you don't. And that's kind of interesting.
I think these 2 points of Oliver and Keith, like on geographic fragmentation and on like kind of regulatory, point actually this question of like, what are the structural advantages and disadvantages of Europe when it comes down to those innovations feeding through, right? Because I actually feel very passionate about like the legal, like I think we have this amazing opportunity in Europe to be not necessarily the biggest ecosystem, but the fastest growing like tech ecosystem. But we need to fix some parts of the framework to enable that to happen, right? And regulation, when it comes down to all the way from setting up funds to closing rounds to actually tax breaks and making investing into tech more accessible is like a huge part of that. So yeah, I really agree.
Interesting. I want to shift gears a little bit. Another kind of innovation that we've observed stateside over the last 5 or 6 years, and Keith, this is very relevant to your business, is seed funds are increasingly raising opportunity vehicles to participate in the financing path of their companies much later than they historically have. Curious if that's made its way over to Europe, and I guess specifically how the bigger kind of later stage funds think about that development. I mean, does it introduce conflict into the ecosystem where it used to be a pure stage focus and then they would kind of hand the reins over to you all at the A, B, or C round? Now they want to keep pro rata a little bit longer. How is there a tension there?
I mean, from our position, we see that as a positive development. And I think, again, referring back to the founders, as for me, that it always starts with them. The founders in the end will have to decide whether they love the relationship with the seed fund and want to have a bigger part of the cap table taken off by their continuation fund or opportunity fund. And if that relationship is fantastic, perfect, let's go for it, right? What we found more often than not is that seed funds were very, very good in the beginning, and founders then graduate to thinking, okay, now I need to shift gears a little bit of how my board should be, the board composition, or other requirements that I have that the investors should bring. And then a fund like us or anybody else who is Series A or later stage comes in, and then we might have situations, and we have had them over the last couple of months, where the opportunity funds of seed funds, of course, want to have a share. But in the end, if the founders say, I want to have a strong follow-on investor, a strong Series A investor, that's normally what's guiding that discussion. Mm-hmm. Only companies that find themselves in a weaker position to be able to raise outside capital, right? They might be happy to have that continuation fund, which is a whole different discussion.
I can give you the numbers on that. So we run a thing called GP Rank, and GP Rank scores seed investors by how good they are at picking winners early. And we have a leaderboard, and it's like a 3-year window, and companies come off it and go on it. And one of the things we track is how many rounds the seed fund does on average in unicorns, just in unicorns, where you would expect they'd do more than in other ones. The average number of rounds a seed round does in a unicorn is 1.6, which means they don't even do their full pro rata at the A. Only 10% of the top 100 seed funds have an opportunity fund, and they're pretty committed to it. People like Jeff Clavier on Cork. Others, like, say, Mike Naples at Floodgate, has never raised an opportunity fund and has never done an SPV. Aileen Lee at Cowboy, the same. Why? Because it's a different life. Once you start doing an opportunity fund, you're no longer a seed investor day to day. You become something different. You have to. You start managing later stage stuff. And that's why partnerships with people like Scale are key, because you don't want to become Scale. You really like doing what you're doing. So I think this trend to opportunity funds is exaggerated, but I also think where they do raise it, it's a mistake. What happens is when you raise an opportunity fund, you tend to use it in all your portfolio. Maybe not all, but certainly you go below the line of where you should be allocating, and you become your own adverse selection because you feel loyal to your companies and you want to help them. And so you end up bridging companies that are not your best companies. So I personally believe that, and by the way, this is why I believe it, because that's what single rank is that capital allocation to follow on should be structured through data, and you should be putting it into the best companies that are going to have the best outcomes, probably your top decile. So like in our world, we have rules. We say, you must have invested twice in your startup for us to do your follow-on. Well, that puts you in the top quartile just with that rule. The second is the B round must happen within a certain period of time from the A. It's currently 12 months because it's learned from the market, and 2021 was a very rapid. Well, that puts you in the top decile. The third rule we have is there must be a B round investor from this list of 50 top B round investors, which Scale is one. And that puts you in the top 5% of the portfolio. Well, imagine the difference between an opportunity fund that gets put into, let's say, 7 companies out of 20, and an opportunity fund like ours that gets put into 1 company out of 20. The returns are totally different. We give the manager 20% carry. Guess what? When they raise an opportunity fund, they only get 10%. So it's even worse economics for them. So I actually think opportunity funds are a fundamentally structural mistake for a seed manager to want to do. And if they do it, they're going to morph into not being a seed manager pretty quickly.
Yeah, I mean, maybe we can split opportunity funds and SPVs because those are closely related. I saw a panel here just half an hour ago from the folks at Top Tier, and they actually have really good quantitative data on opportunity funds. You can check it out on their website. And a lot of these opportunity funds in aggregate over the last 10 years have performed really well. The objective data actually says they do really, really well. I think where it makes me nervous, and I wonder what the next 10 years are going to look like, is when the opportunity funds are larger than the core funds, that dollar exposure at later stage higher prices has to be strong and continue to be strong. Otherwise, it's just going to trump the exceptional performance that you get at that really early stage risk at a lower price. And so when you start seeing some of these managers manage these very large opportunity funds with a small early stage fund, how does that evolve in a more challenging market environment? I'm a little wary of it. And then on the SPV side, I think, look, it's a tool that really early stage managers should consider. But I think that we're like so deep into this bull market, clearly it's turning. I think people forgot what reserves were for. I started my career modeling down rounds and thinking of reserves as like a defensive tool in order to protect your positions in companies. And the whole mentality now around pro ratas and so forth is about building ownership and piling into your winners. But like we are going to have another market again, and we might be having that market where you're just scrambling to try to get your company's financed. And like, I hate to say it, if you're one of the funds on that cap table and you don't have reserves, like you'll get crushed on a pay to play. And I think there's a whole generation of managers that haven't even thought about that. And I'm a little worried about that because the exact same time that the companies start having problems is also the exact same moment that the access of capital through SPVs totally disappears. And so those moments always coincide and end up having really bad outcomes. And so I really hope people are considering their reserve strategies as we're seeing a bit of a pullback in the markets.
I'd love to second that, frankly. So I think for the market, right, continuation funds, etc., it's more money for the ecosystem, which in general, I think Europe has many ecosystems and that's good. But from a fund manager perspective, I couldn't agree more. I mean, we have across early and growth stage fund, we're quite disciplined on the early stage fund with 250 million across the various generations. We're extremely rigorous on reserve allocation. So even last year when the markets felt a little bit hot, I mean, we'd never deviated from the strategy, ending up with a portfolio now where 90% of NAV has like more than 2 years of runway. Plus we have significant reserves against. We suddenly feel extremely, extremely safe because we didn't overdo it, knowing that we could feed it from other pockets. So that discipline, right? If you raise another pocket, that discipline might go down. And so I think that in the end, coming out of a 10-year cycle where many of the, especially European early stage funds, they've never lived through a downturn. We always had sunny days in Europe. And I think many of them still have to learn that. And that's, I think, where we really appreciate working with some of those managers that have been around 15, 20 years, because that in the end, those are the ones, and we see ourselves as one, that will carry a market through a little bit of a tougher time without running into cash crunches all the time.
Interesting. One other trend I'd love to get your thoughts on that we've seen, or I guess we had seen over the previous handful of years, probably ending in December 2021, was the prevalence of secondary liquidity for early stage funds, right? I think, when I joined my partner Michael 8 years ago, we kind of envisioned seed funds having a second way to win because you weren't entirely reliant on the IPO market. There was also this M&A, small M&As could still impact your fund returns. I don't think we fully envisioned the opportunity that secondary liquidity presented, and we've seen our fund managers really take advantage of it over this bull market, taking 10, 20% of a position off the table in some of these rounds. Curious if that's prevalent over here in Europe. Do you see the early stage funds taking some capital off the table? How do the multi-stage funds think about that? Is there any kind of signal there? Do you worry about it? Curious how it's thought of over here.
I mean,
you go with multi-stage and I'll go with one-stage.
It's tough to make a blanket statement there. I think in general, it always depends on the reasons. Of course, if an early stage fund sees something that we don't and they suddenly want to sell the entire position, it gives us pause. In general, I would say creating secondary liquidity, we've rarely seen a downside of that. For early stage funds, for angel investors, even for part of the management team, the founding team, etc., it can actually make the entire situation much better. If 2-3x times the fund is the NAV position of a single great investment, that fund is always going to be nervous. If you have that partner on the board, they will make a decision maybe more from a risk aversion perspective than from a different perspective. And so in that moment, we'd appreciate them taking a little bit of risk off the table and are totally fine with it. There might be other reasons, so it's tough to blanket it.
I think one of the advantages of micro funds is the flexibility that you have because your stake is small, right? And I think we always looked at that as when you actually look at the distribution of returns, exits in the few hundreds and even low, they're quite rare to actually materialize. But when you think about it in valuation of rounds, that becomes much more frequent. And so we always thought about it as an opportunity to kind of materialize returns much earlier. And this was in another market. In the current market, actually, I think it is almost the flip side to the discussion we were having on follow-ons. Because when you think about it now, if the expectation from founders and from other investors that come after is that you need to follow on, you end up putting a lot of bad money over bad money, or even actually money over what looked like good money, but at valuations that now look very hard to meet. So you find a lot of early stage funds that invested a lot of money into companies that flew for the last 2 to 3 years, and now they're there with a super big exposure. They didn't get out, rather the contrary, they were doubling down. And now, so I think we're all learning on how you can actually get really disadvantaged positions if you don't manage your secondaries right.
I can tell you a couple of relevant anecdotes here. Last week I spoke with Dave McClure, some of you know is the former founder of 500 Startups, and he's now doing secondaries. He buys LP positions primarily. And he told me that his book is double what he can do because of the adjustment in the market. Everybody wants to sell. And he's saying, once it gets to 40% of NAV, he'll buy. And currently the expectation is 80% of NAV, and he's not buying. So it's a buyer's market in the secondary today. However, I do think if we look a little bit further out, and that's my second anecdote, I was the guy in the room a few years ago when Seed Camp sold funds 1 and 2 to Draper. Simon Cook at Draper and Reshma didn't know each other, and I introduced them. And Simon's fund bought funds 1 and 2, and it had TransferWise in. And it was a fantastic purchase for Seed Camp because they got liquidity. And it was a fantastic purchase for Draper because they've gone significantly up since they bought it. And she also wanted to, by the way, sell Fund 3, where Yandex was an LP and didn't want to be an LP anymore. And Revolut was in that fund and couldn't sell it. Now, here's what I think is going to happen. With the public markets becoming much further out in the life of a company, secondaries are going to have a new life. They're going to come back big time as a liquidity vehicle. The buyers will need to be offered incentives to buy, which will take the form of discounts to NAV. And as long as I think 80% of NAV is probably a realistic, in a normal market, a realistic price. As long as you sell at the right stage where there's still growth in the assets. For us at least, we've built in that liquidity into our we call them cohorts. We invest in 3-year cycles. Where do we get the cash after the first cash? We're gonna structure secondaries. And I think that's really important for all of us to embrace those secondary buyers and see them as a way that we can recycle our money more rapidly.
And this is probably also like a key difference between the US and Europe. Yet, like the liquidity in secondary, not only like at exit level, but in secondaries, both for shareholders and employees, and how you manage that. So I think that is innovation that still needs to like trickle down more into Europe.
Yeah, I don't know the difference between the European and the US markets on this topic, but I've always thought it was curious that I can go out and buy Salesforce stock in the public markets, and nobody ever wonders why is the other person selling, right? We just presume they have a reason, and I have a thesis, and I want to buy that stock. And for many years, it persevered within the venture industry that if somebody was selling, there must be a negative signal in that, right? Like there must be some sort of piece of information that this company has. And I think that if you have the ability to diligence and you have the ability to think independently, you shouldn't view it as negative signal. You should say, I know something about this, and this other person has a different perspective, and I'd like to make that trade. And so, you know, we at scale, if I take a look at the last 20, 25 deals that we've done, a vast majority of them have had some sort of founder liquidity in the process. If you look at the length of IPOs, even at IPOs, those founders can't ever really take money off the table. And so providing liquidity along the way is really intelligent. And then I do think we're seeing an emergence of, you know, particularly in the US, but I know there's a bunch of transactions in Israel and other places where early stage managers are starting to cycle out of some of their liquidity as well. And I think that's super, super smart, right? You're taking away a little bit of upside, but you're ensuring like returns on that. And if you think about what you're trying to do as a venture manager over a series of funds is deliver consistency. And so if you can use the secondary markets in order to do that, I think that's really, really exciting. I think the part of the market that still hasn't resolved this that we struggle with is if you're sitting on the board of these companies and you're building a relationship with that management team and that CEO, and you're doing everything that's required in order to be in that board seat, when you then turn around and tell the CEO, oh, by the way, I just sold 40% of my position, those conversations don't go well today. And so I think we as an industry still need to mature our thinking around that and how that happens. And so I think that's a real limitation. And I'm not sure that's a European versus America versus Israel dynamic. That's just where those board founder relationships are right now. But gosh, if you're a nano fund and you got in there and you don't have a board seat and maybe the company's outgrown you and you don't have that much interaction with the CEO anymore, cap that upside and get those returns, you know?
By the way, I've got a ton of stock in Infarm that I'm happy to do a secondary on it. Anyone who's buying.
Wonderful. So last question from me, and we can make this one quick. You know, I would say over the last cycle, we've seen in the States a real rise of specialization in fund strategy with kind of highly verticalized, you know, prop tech or fintech or health tech or whatever it is. Have we started to see that happening in Europe? And do we think it's a positive sign for the maturity of the ecosystem?
It's coming up, and especially on the early stage side, very, very specialized funds. We have a thesis approach, so we're extremely deep in deep tech, fintech, healthcare technology, and I think can hold our water with those absolute experts. But among our multi-stage funds, we see most of them actually don't. Like other funds are much more broad and don't have the true expertise inside. So I think on that end, it still needs to mature. Early stage side, 100%.
Yeah, I mean, look, we tell our starts with focus, and then we often contradict ourselves, right? Like, I think if you're trying to get a fund off the ground, focus. And maybe persistent in that forever. And I do think I'm seeing more of the European managers have really good focuses. I mean, you can look at like Point Nine Capital, right? Like we're going to do SaaS and we're going to do that really well. Look at all the success they've had around that. And the brand, it's easy with focus to build brand. And we think about the managers who share focus with us as the folks that we're going to have more dialogue with.
I think it's a matter of like the more competitive the market becomes, the more you need to differentiate. So the more you need kind of a superpower. Now, I have a bit of a controversial view on how that superpower needs to look, because there's definitely a superpower on thesis, and you can be thematic and build a lot of expertise on brand on that. And we're seeing a lot of that, like Point Nine is an example. Crane is another great example and very specific. On Frontline, there are many. We can see that as geographic focus as well. You have like Creta, but ultimately, when you're doing pre-seed and you're like a nano fund, I come from highly thematic funds. Felix was super into consumer, and then I was a partner in a fund that only did network effects. And actually, when I compare my kind of investments as a VC to my angel investments, I realized that the angel investment portfolio was super diversified, because ultimately I was betting on founders, and the most information you have at that stage is actually founders. So in my thinking, if I were to just choose a sector at that stage, I might be missing on certain things, because the data I have to make decisions at that point is mainly based on founders. So how we found our superpower is in a very unique positioning of, look, we invest like angels, but we bring on the VC network, VC expertise. And that is sort of our focus. And so I think like you can see many different ways to build that superpower, but the more competitive the market becomes, and now the more it corrects, the more it's needed and the more we're seeing it.
But by the way, I agree with, like, I think you're hyper focused, right? Like, it's because you're like, we're only going to do this like super, super early stage focus. So I think you can focus in multiple different ways.
I was going to say, when you look at the scoring of the seed managers, almost every seed manager in the top 100 is a generalist, almost all of them, because this specialism hasn't really emerged yet. Now, Point Nine is an exception. They're in there. I can't think of a second exception. Top is Y Combinator. They're the number one performer in seed. Second is SV Angel. The top overall is Initialized Capital, Gary Tan. And you look at these guys, they're just really, really good people. That said, it's a real mistake to hard code that, because, as you said, there's all this new trends emerging. And I think that sitting in my seat, you've got to be like the Louvre Art Gallery looking at artists. And remember, you're not the artist. They're really good at doing what they do, all of them. And that's why they're in that list. And you should just partner with them and help them, and don't pretend that you know better than they do, because they're the ones who know. My old colleague, Mike Dimolo, who was with me at ADV, is in, I forgot what the name of it is. You might remember the name of the fund. But anyway, he's in a specialist deep tech fund in the UK now, and they only do deep tech. Another one is a fund that only does space tech. So it is definitely happening.
Right.
And they're going to definitely have winners. But it's only just bubbling up into my visibility.
Wonderful. Well, thank you all so much. We are out of time, but I enjoyed the conversation. Hope you all did as well, and appreciate you all taking the time.
Thank you.